I met a school friend recently. It had been years since we last met, so we asked each other about our lives and careers. When he learned that my work revolves around investing and personal finance, his eyes lit up. He immediately pulled out his phone and asked me to help him demystify his portfolio. Obviously, that puzzled me. I asked him why he invested in so many different products, some of which he didn't really understand. His answer was something most of us can relate to. Some were suggested by his friends, some were pushed by bank's RM, and some he came across on his own and found lucrative, and so on. Unfortunately, he is not alone. With thousands of products available and new ones being invented and launched every day, it is not easy to figure out which ones are right for you. But worry not. In today's video, we will discuss a standard mental framework that you can use to judge the suitability of any investment product while staying clear of fraudulent or dangerous ones. Hello and welcome to ET Money's YouTube channel. Now, the standard mental framework we will talk about will be in form of 5 questions that you should ask before investing in a financial product. With answers in your hand, you will be able to judge whether a particular product is fit for you. Conversely, it will help you avoid the ones that won't do you any good, thus helping you stay out of harm's way. Now, this is what makes this video absolutely important for any serious investor. So do watch it until the end. You can also share it with your loved ones so they can also benefit from it. Okay, now this video belongs to our playlist on investing lessons. To watch more such videos, you can explore it. The link is in the description. Okay, let's begin with the first question you should ask when you come across a financial product. A lot of times when you come across an investment product, or if an investment product is being pitched to you, returns are the first thing you note. However, what you should be asking is how those returns have been delivered. In other words, how does this investment makes money? Now, the classic ways an investment can generate returns is by investing into asset classes. The prominent asset classes are equity, debt, commodity, and property or real estate. Now, these asset classes have their own characteristics, and based on the exposure an investment takes, you can judge its behavior. For instance, equity is known to be rewarding in long run, but also volatile in the short term. So, if an investment product is based on equity, you can expect it to exhibit these characteristics. Similarly, debt is expected to be steady, but is comparatively less rewarding. Commodities like gold and silver and real estate have their own drivers, and an investment in these assets will be influenced by the related drivers. The point is that rather than focusing on the returns, you should focus on the investment's behavior and why it has generated the returns that it has generated. That can give you a window into what it is capable of doing and not doing. That can in turn help you set your expectations right. Now, focusing on how an investment works or generates returns can also help you avoid dubious investments. Say an investment peddler comes to you and says that a certain product can double your money in 1 year. That's 100% returns in 1 year. Quite tempting, right? But as discussed, let's not focus on returns. Let's ask how this investment generates returns. So ask the investment salesman how this investment makes money. After all, for an investment to give you 100% in 1 year, it must generate even more than that for its sellers. Otherwise, they will be in a loss. Now, you may have an idea of the short-term returns equity, debt, and gold can generate. Historically, none of these are anywhere near 100% promised by the investment salesperson. Now, when you tell that to the salesperson, he'll come up with a confusing, fantastical explanation, some exotic idea, some revolutionary underlying product, or a secret avenue. All these should be bright red flags for you. Often, products that promise returns that are too good to be true are Ponzi schemes. Now, this word Ponzi has a very interesting story. This word comes from the name of Charles Ponzi, an Italian conman who lived during the first half of the 20th century. Ponzi promised his investors returns of 50% in just 45 days or 100% in 90 days. But quite obviously, such returns weren't possible. All Ponzi did was pay back old investors with the money deposited by new investors. His fraud caused his clients to lose about $20 million. This is how Ponzi schemes work. Old investors are paid with the money of new investors, and this cycle keeps on going till the scheme has a large corpus. At that point, the investment company simply shuts shop and runs away with all the money. In general, if the returns promised sound too good to be true, you should be cautious. Now, a related case here is of a dubious asset class. An investment whose underlying asset is itself shady is a bad investment as well. To know if the asset class itself is shady, ask where it derives its value. If there is no reliable answer, chances are you are dealing with a shady asset. For instance, equity derives its value from the earnings potential of its underlying business. Debt derives its value from the creditworthiness of its borrowers. Gold, silver, and real estate have been storehouse of value since time immemorial. What about crypto? Who determines their value? Assets based on the greater fool theory, that is, whose worth is driven by the notion that someone else would be willing to pay a higher price later, are ripe for blow-ups. In the 16th century Holland, amid the so-called tulip manias, tulip bulbs commanded exorbitant prices, going as high as $1 million in today's money. But the bubble eventually burst, leaving tulip investors decimated. Now, by asking how an investment works, how it makes money, where it invests, and whether the asset class itself is sound, can help you avoid a lot of pain later on. Now, this brings us to the next question. As we discussed a little while earlier, returns from the investments are the first thing that catches investors' eyes. But more important than returns is the risk taken to generate those returns. As such, before returns, risk must be evaluated. Now, many investors equate volatility with risk, but volatility is not a risk. It's just an indicator that risk is present. So what exactly is risk then? Well, risk is the probability of a loss of capital. For instance, consider the percentage of instances of negative returns from the Nifty 500 TRI across time frames. If held for at least 5 years, there was a zero probability of loss if we consider the data for the last 10 years. That's why an investment horizon of at least 5 years is recommended for equity investing. Now, to generate high returns, often high risk is taken. Such a risk can serve well when the markets are doing well, but it can severely backfire when the markets fall. So what's a good investment then? A good investment is one that generates market-like returns when the markets are going up and protects the downside better when the markets are falling. Now, risk can originate from market-driven factors. For instance, pricey assets tend to carry high risk. Risk can also arise from non-market factors. For instance, if an investment product is unregulated, it's highly risky. Now, if there's a healthy chance that you can lose all of your capital in an investment, that investment is super risky, no matter what its return potential is. This is especially true for derivatives like futures and options. Now, risk is also a function of investor behavior. If you don't understand an investment or don't have knowledge or experience in handling it, such an investment can be highly risky for you. That's why the late investment great Charlie Munger advocated focusing on your circle of competence. All in all, before you jump on an investment looking at its returns, try to assess the risk in a 360-degree manner. It's only after you have understood the risk involved and are willing to bear it should you take the next step. Now, if you'd like to understand investment risk in greater detail, we have a full-length video on it. I've included its link in the description so you can watch it later on. Okay, now let's move to the next question. Let's now talk about the returns aspect. Returns are the main reason why you make an investment. So it's little surprise that returns are often revealed to you upfront. Now, what you need to ask here is what kind of returns. For instance, are the returns assured or they are market linked? Or are the returns pre-tax or post-tax? Will they arrive via capital appreciation or interest or dividends or all of this? It's important to ask these questions as returns are often communicated in a way that makes them look most appealing. Your challenge is to arrive at the most realistic picture. For instance, equities are believed to have delivered good 12 to 15% returns over the long run, but the reality is rather complex. Based on the last 15 years data, there was a 1/3 chance that you got returns less than 12% in a 5-year period. In 2.1% of the instances, your returns were even below 5%. Now, this suggests that if the returns are market linked, past returns can give you a broad idea, but they are far from being certain. So, estimated market-linked returns should always be taken with a grain of salt. This aspect finds its use in financial planning too. While estimating market-linked returns, always be conservative. It's always advisable to factor in 2-3 percentage points less than the fair estimate of returns. Now, the metric used for calculating returns can distort the picture too. For instance, for a mutual fund, there are trailing returns, rolling returns, and SIP returns. They can each present a different picture. Consider these types of returns from the Nifty 500 for instance. Similarly, FD returns can be quoted in terms of interest rate or annualized yield or effective annualized yield. Now, to learn more about these aspects and how financial numbers tend to fool investors, you can watch a related video. The link is in the description. Now, apart from the type of returns, also try to quantify the worst case scenario. That is how bad it can get. Of course, what happens in the future is anybody's guess, but past data can provide a good insights. For instance, take a look at the worst returns delivered by the Nifty 500 across short periods up to 1 year. So if we consider the Nifty 500 as the equity proxy, an investor must be mentally prepared to see a downturn of over a third of the portfolio value in the short term. An investment that can lose all your capital in the worst case must be diligently avoided. Now, another thing that will directly impact you is the tax you pay on an investment product. We often see returns pre-tax, so the impact of taxation on our returns remains invisible. But the higher the taxation on a product, the less you get back in hand. So it's advisable to look at the taxation of a product before investing in it. One prominent case here is a bank fixed deposit, which are go-to option for many risk-averse investors. FDs are taxed at the slab rate. For someone in the highest tax bracket, that means an outgo of about a third of the returns. So a 7% FD ends up delivering just about 5% for someone in the highest tax bracket. Even debt funds are taxed at the slab rate. Now on your screen is a crisp summary of the taxation of various investment products. To understand the capital gain rules in detail, you can watch our video on this topic. Now the next related thing to understand is the fee structure of the investment in question. High fees can eat into a major chunk of your returns, and that's especially painful when the investment itself is going through a lean phase for understandable reasons. A prominent example of high charges is many offline unit-linked insurance policies. Their cost structure is so configured that the initial year premiums are consumed in costs alone. So if you surrender such a ULIP after a couple of years, you suffer a massive loss. Now, as far as insurance policies are concerned, whether traditional or unit-linked, if you'd like to learn more about the surrender options and when you should exit them, you can watch our full-length video. The link is in the description. Now, this brings us to the next question. Liquidity or the ease of buying into and selling out an investment is an important consideration. If an investment can be easily liquidated, it's usually a big plus. After all, that enables you to have access to your money anytime. On the other hand, if an investment can't be liquidated easily or can't be liquidated at all before a certain period, there has to be a strong logic to opt for such an investment. For instance, most mutual funds, stocks, listed REITs, and many types of bonds have sufficient liquidity, and one can get in and out of them easily. But many tax-saving investments, the NPS, small savings schemes, etc., have a lock-in period of some kind. Now you can assess if the investment product is lucrative enough for you to forget the lack of liquidity. A case in point is the NPS. The NPS is a retirement product, so it's no surprise that your money remains locked until retirement. Of course, there are certain cases where you can withdraw money from the NPS prematurely, but let's talk about the standard case here. The NPS can be a good retirement saving product as it allows investment in equity and helps build wealth. It has attractive tax benefits both in old and new tax regime, which effectively boost your net returns from it. In fact, the corporate NPS is one of the very few tax-saving avenues available in the new regime. So it's highly useful to those opting for the new regime. Now, if you'd like to know more about the corporate NPS, we have a video on that. I've included its link in the description so you can watch it later. Now, investments that have a lock-in period of some kind have another useful advantage. They help develop investment discipline. This is especially useful for new and young investors. Also, if you tend to overreact to market movements and are prone to taking knee-jerk reactions, investments with a lock-in option can help you stay put during tough times. Now, tax-saving mutual funds or equity-linked schemes have lost their appeal after the sweetening of new tax regime. But these funds can continue to be useful for new or edgy investors. These funds compare well with flexicap funds, so one can very well consider them as a flexicap fund with a lock-in option. Now this brings us to the next and the final question. Some time back, a cousin of mine visited my place. For the few days he stayed with us, our whole household got disturbed due to his unique lifestyle. I mean, he played music at night, slept till late in the morning, and strange eating habits kept the house untidy and so on. We thanked God when he finally packed his bags and left. Now, new investment is also like a new family member. If it fits in your financial household, you will enjoy its company. If it doesn't, it can turn the house upside down. So one useful perspective of evaluating whether or not you should invest in a product is how well it goes with your investor profile, preferences, financial goals, and your existing portfolio. For instance, if you are a retiree who is dependent on accumulated corpus, it may not be wise for you to dabble in high risk products like derivatives. If you don't have time and knowledge to pick stocks, it may not make sense for you to invest directly in stocks. If you're looking to build wealth, another fixed income product in your portfolio may be of limited value. Overall, before investing in a product, you must evaluate what purpose it serves in your investment plan. Last but not least, understand the opportunity cost of investing in a product. The opportunity cost of investing in a product is not investing in another product or an existing product in your portfolio. Now, if the existing product is working well and you decide to invest in a new product, there must be a very good reason for doing so. In investing, it is often wise to continue to do what you have been doing if it's producing good results. To paraphrase Paul Samuelson's famous quote, good investing is also boring, and you shouldn't use investments to add thrill and excitement to your life. This is what I had for you today. I hope you like the 5-point framework to help you evaluate any investment. To summarize, whenever an investment comes to you, ask yourself these 5 questions. First, how does this investment work? Second, what's the risk involved in this investment? Third, what kind of returns does it generate? Fourth, how liquid is it? And fifth, does this investment fit into your financial plan? I'm sure if you ask these 5 questions, you won't fall for the siren songs of investment salesperson, crooks, and anyone else who doesn't have your best interest in mind. And that's all I had for you today. If you liked this video, do share it with your friends and family and help us reach more people. I'll be back soon with another video. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.